Wall Street just got blindsided. After months of headlines claiming inflation was cooling, the economy was resilient, and the next move from the Federal Reserve would be rate cuts. Everything changed in a flash. The mood on Wall Street has shifted from confidence to fear, and when fear returns to the market, it never arrives quietly. It begins with sharp red candles, violent reversals, sudden selling, and confused analysts scrambling to explain what just happened. Then it spreads into something bigger: panic, doubt, and one terrifying question: what if the danger never went away? Because that is what investors are starting to realize right now. They were told inflation was under control. They were told higher prices were temporary. They were told the economy could absorb higher rates forever. They were told stocks could keep climbing because the worst was behind us. But now inflation pressures are showing signs of returning. Energy costs remain unstable. Food prices are still elevated. Everyday families are already stretched thin. Borrowing money is expensive. Credit card balances are rising. Delinquencies are creeping higher. Businesses are slowing hiring. Consumers are becoming cautious. This is not the backdrop of a healthy boom. This is the backdrop of a system under pressure. And when markets finally recognize pressure, trillions can disappear faster than people imagine. That is why Wall Street suddenly looks nervous, because the nightmare scenario is no longer impossible. Inflation stays high, while growth slows, while rates remain elevated, while debt burdens rise. That combination can hit stocks from every direction at once. Higher inflation hurts confidence. Higher rates hurt valuations. Slower growth hurts earnings. Fear hurts everything, and if that cycle accelerates, the selling can feed on itself. This is where investor psychology becomes dangerous. At the top, people feel invincible. They buy risk. They ignore warnings. They believe every dip is an opportunity. Then one bad report changes sentiment. Then another headline confirms the weakness. Then a few large funds reduce exposure. Then retail investors see losses and panic. Then everyone wants safety at the same time. That transition may already be starting, because while many people still hope this is just another temporary scare, something interesting is happening beneath the surface. Gold is gaining attention again. Silver is back in the conversation. Why? Because when trust in the system starts to crack, money searches for shelter. Not excitement, not speculation. Shelter. Gold has historically represented protection during monetary stress, inflation fear, and geopolitical uncertainty. Silver often follows with sharper momentum once panic buying expands. And smart money understands something the average investor learns late. By the time television confirms the crisis, the repositioning has already happened. That means if Wall Street is suddenly talking recession risk now, some institutions may have been preparing quietly for weeks. Rotating, hedging, reducing risk, buying protection, watching data that most people ignore. So ask yourself this: why are markets becoming unstable if everything was supposedly fine? Why are defensive assets attracting attention if the soft landing was guaranteed? Why are investors suddenly nervous if the recovery story was real? Because markets move before headlines do. And headlines often arrive after the damage begins. This may be the moment investors remember later and say, "That was the warning. That was when confidence cracked. That was when recession panic returned." And if this is only the first wave, then the next move could be far more violent than most people expect. Because Wall Street does not fear bad news, Wall Street fears being wrong, and right now, the market may be realizing it was wrong about inflation, wrong about rate cuts, and wrong about how strong this economy really is. If that realization spreads, then what we've seen so far may be nothing more than the opening tremor before the real shock hits. But the red numbers on Wall Street are not the real story. They are only the symptom. The real story is what has been building underneath the surface for months, while many investors were distracted by rallies, headlines, and short-term optimism. Pressure. Relentless financial pressure. Because economies rarely break all at once. They weaken slowly, quietly and then suddenly. First, the cracks are ignored, then they are explained away, then one day they become impossible to hide. That may be where we are now. The first major pressure point is energy. Oil does not need to stay high forever to cause damage. It only needs to remain unstable long enough to inject fear into businesses, consumers, and markets. Every sudden spike in oil acts like a tax on the global economy. Transportation costs rise, shipping costs rise, manufacturing costs rise. Food costs eventually rise. And when those costs rise, inflation can return faster than policymakers want to admit. That is why investors watch oil so closely. Because oil can restart inflation even when central banks believe they are winning. And if inflation returns, the Federal Reserve has a problem. Markets were hoping for lower rates, easier money, and a new cycle of growth. But if inflation remains stubborn, rate cuts become difficult. If rates stay high, borrowing remains painful. Mortgages stay expensive. Credit tightens. Businesses delay expansion. Consumers cut spending. That means the same medicine used to fight inflation can end up slowing the economy harder than expected. Now add the second pressure point, debt. Households are carrying expensive credit card balances. Auto loans are heavier. Mortgage affordability remains stretched. Governments are carrying enormous deficits. Companies that borrowed cheaply years ago now face refinancing at much higher rates. Debt was manageable when money was cheap. Debt becomes dangerous when money is expensive, and expensive money changes behavior quickly. Consumers stop upgrading. Families delay purchases. Small businesses postpone hiring. Companies cut costs. Investors become selective. That is how momentum fades. The third pressure point is earnings. Stock markets can ignore bad news for a while, but eventually they must confront profits. If consumers slow down and financing stays tight, corporate earnings face pressure. Guidance weakens, margins compress. Growth assumptions get revised lower, and when earnings expectations fall, richly valued stocks become vulnerable. This is why markets can look strong one month and fragile the next, because confidence is often built on assumptions. Assumptions that inflation will cool. Assumptions that rates will fall. Assumptions that spending will continue. Assumptions that geopolitics will calm down. If enough of those assumptions fail at once, sentiment can reverse violently. Now, watch investor psychology during this stage. At first, people say it is noise. Then they say it is temporary. Then they say the dip is healthy. Then they begin asking why safe haven assets are rising. Then they realize institutions may be repositioning. That realization creates urgency, because nobody wants to be the last person holding risk when the crowd runs for the exit. This is where gold and silver start looking different. Gold becomes less about upside and more about protection. Silver becomes less about industrial demand and more about catching up to fear-driven flows. Neither asset needs euphoria. They only need distrust. And distrust is rising. Distrust in inflation forecasts. Distrust in policy promises. Distrust in earnings optimism. Distrust in the idea that markets can levitate forever while the real economy strains underneath. That is why this moment matters. Wall Street may still bounce. Headlines may still celebrate every green day. Analysts may still debate soft landing versus hard landing. But beneath that noise, the pressure continues building. Oil remains a wild card. Rates remain restrictive. Debt remains heavy. Consumers remain tired, and markets remain vulnerable to disappointment. The dangerous part of a build-up phase is that it often feels boring right before it becomes dramatic. People become numb to warnings, then one catalyst arrives. A hot inflation report, a major earnings miss, a sudden oil spike, a credit event, a policy shock, and what looked manageable instantly becomes panic. So while many investors are waiting for official confirmation, smart money may be focused on something simpler. You do not wait for the fire alarm if you already smell smoke. And right now, Wall Street may be smelling smoke everywhere. And then it happens. The moment markets fear the most, the moment when investors realize this is no longer just an inflation problem, and no longer just a slowdown problem. It is both at the same time. That combination can terrify Wall Street because it creates a trap with no clean solution. If growth is slowing, central banks normally cut rates. If inflation is rising, central banks normally keep rates high. But what happens when the economy weakens while prices stay elevated? That is when panic begins. Because the usual rescue tools stop looking reliable, this is the stage where every headline feels dangerous. A hot inflation number tells investors rates may stay high. A weak jobs report tells investors the economy is cracking. A poor earnings report tells investors profits are shrinking. An oil spike tells investors inflation could get worse again. No matter which headline arrives, markets find something to fear. That is how confidence breaks. At first, selling looks orderly. Funds trim positions. Risk managers reduce exposure. Traders hedge aggressively. Analysts lower targets. Then the emotional wave starts. Retail investors open their apps and see red across everything they trusted. Stocks down, crypto weak. Growth names hit hardest. Yesterday's leaders suddenly look fragile. People who said they were long-term investors begin asking if they should sell. People who bought the dip start wondering if the dip was only the beginning. People who felt rich weeks ago now feel exposed. This is where market psychology becomes brutal. Losses hurt more than gains feel good. That means once fear takes control, rational thinking weakens fast. Investors stop asking what something is worth. They ask how fast they can get out. And when too many people ask that question together, volatility explodes. You begin to see violent intraday reversals, sharp rallies that fail, green openings that turn red, panic selling into the close, hope in the morning, fear by afternoon. That emotional whiplash drains confidence from the entire system. Meanwhile, something else begins happening quietly. Gold starts strengthening, not because everyone suddenly loves metals, because they no longer trust everything else. Gold benefits when real confidence falls, when policy credibility weakens, when recession risk rises, when investors want something outside the financial promise structure. Silver can move differently. It often sleeps during the early warning stage, then wakes up violently once fear becomes mainstream. It attracts traders looking for a smaller market with bigger upside torque. That is why silver sometimes becomes the panic accelerator. First gold moves, then silver chases harder, then the public notices late. This is also when institutions and average investors separate. Institutions manage risk early. They hedge before certainty. They rotate before headlines confirm danger. They care less about being perfectly right and more about surviving large drawdowns. Average investors often wait for clarity. But clarity in markets usually arrives after prices have already moved. That delay can be costly. Now add one more layer to the panic. The Federal Reserve appears trapped. Cut too soon, and inflation may reignite. Stay tight too long, and recession deepens. Either path creates fear. That means investors who once depended on the Fed rescue may start doubting whether rescue can come quickly enough. And when markets lose faith in the backstop, selling pressure can intensify. This is why peak panic feels different from a normal correction. A correction says prices moved too far. Peak panic says the system assumptions may be wrong. Wrong about inflation cooling, wrong about consumer strength, wrong about earnings resilience, wrong about how long high rates can be tolerated, wrong about how stable markets really were. That realization can reset valuations fast. Suddenly, expensive stocks look dangerous. Speculative assets lose sponsorship. Cash becomes attractive. Hard assets gain attention. Defensive sectors outperform. Narratives that looked unstoppable collapse in days, and the crowd begins chasing safety at worse prices than the smart money paid earlier. That is the cruel math of panic. Late exits, late hedges, late gold buying, late silver chasing, late awareness. So if Wall Street is entering this phase now, the biggest danger may not be the headlines everyone sees. It may be the forced reactions still ahead. Because when fear spreads wide enough, people do not sell because they want to. They sell because they feel they have no choice. And that is when markets can fall far faster than fundamentals alone would suggest. So now we arrive at the question that matters most. Is the damage already done? Or is this only the beginning? Because history shows something investors repeatedly forget. Major market declines rarely announce themselves in one clean moment. They begin with warnings, pauses, failed recoveries, and false confidence. They give people chances to escape, but only if those people recognize the danger early enough. That is why this moment is so critical. Many investors are still waiting for reassurance. They want one strong rally, one calming statement from the Federal Reserve, one cooler inflation report, one clean earnings season, one headline that tells them everything is fine again. But markets do not owe reassurance to anyone. Sometimes they recover quickly. Sometimes they trap hope again and again before the real decline unfolds. That is what makes late cycle markets dangerous. They confuse people. One week optimism returns, the next week trillions vanish. One day analysts celebrate resilience. The next day recession warnings dominate every screen. That emotional instability is not normal strength. It is often a sign of deeper fragility. Now think about the next possible catalysts. Another hot CPI report, another oil shock, a major bank warning, weak consumer spending data, rising unemployment claims, a surprise corporate earnings miss, a geopolitical escalation that hits supply chains overnight. Any one of these can shake markets. Several together could ignite something far larger. Because once confidence weakens, markets become more sensitive to every negative surprise. That means events that would normally create small reactions can suddenly create violent reactions. This is how panic accelerates. Not from one disaster, but from a chain reaction. Confidence falls, selling increases, liquidity thins, volatility rises, fear spreads, more selling follows, and suddenly people wonder how prices moved so far so fast. At the same time, capital starts looking for refuge, not stories, not hype, not promises of future growth. Refuge. That is why gold remains relevant in every era of uncertainty. It is not dependent on quarterly earnings. It does not need management guidance. It does not require consumer confidence. It often gains attention when trust in paper systems weakens. Silver adds another dimension. It can act as both a monetary fear trade and a momentum trade. When panic broadens and metals become mainstream again, silver can move with surprising speed. This is why many seasoned investors watch metals before headlines catch up. They understand a simple truth. Money often whispers before the crowd screams. So what should viewers understand right now? This is not about predicting exact dates. It is about recognizing conditions. Sticky inflation, high rates, heavy debt, fragile sentiment, expensive valuations, geopolitical risk. Those ingredients can stay dormant for a while, but when ignited, they can move markets violently. And here is the final trap many fall into. They wait for certainty. They wait until recession is officially declared. They wait until the media says panic is real. They wait until gold already ran. They wait until stocks already repriced. They wait until protection becomes expensive. By then, the easy decisions are gone. The market rewards preparation more than reaction. That does not mean panic. It means awareness. It means discipline. It means understanding that preserving capital during dangerous periods can be more powerful than chasing gains in unstable ones. Because fortunes are not only made in bull markets, they are protected during storms. And if this recession panic deepens, if inflation proves stubborn, if Wall Street finally accepts the era of easy money is over, then the next chapter could shock millions who still believe this is just another harmless dip. So watch closely. Watch inflation, watch oil, watch the Fed, watch credit stress, watch gold, watch silver. Because the biggest moves often begin while most people are still calling it temporary. And by the time everyone agrees the crisis is real, the smart money is already gone.